Kim Griffin, Member Engagement Director of Tonic, is joining us, and Andrew Lee, Managing Director and Head of Sustainable and Impact Investing at UBS. Thank you both for joining us. How are you doing?
Good, thanks for having us.
Yeah, thanks for having us.
Kim, for those in our audience who are unfamiliar with Tonic, can you please provide some background on the organization and your role?
Yeah, absolutely. And you'd be forgiven for not knowing what we are. Our name, unfortunately, does not explain what we do. We are not in the beverage industry, but we were named as an intentional complementation to the gin. So gin and tonic go very well together, in my experience. So Tonic is a global peer network for impact investors. So we serve high net wealth individuals, family offices, and foundations who are working to align their capital with their values. And we do that with a variety of programs. We help our members connect to learning opportunities, to understand how to be an impact investor, as well as connect with each other with a shared deal flow platform so that they can become co-investors, learn where people are investing, and then more broadly, understand what are the impact strategies that are going to help them make the world that we all need to live in. And then we also have, in addition to our membership services, we have some field building initiatives where we are looking to preach beyond the choir, as we say, and start to use what we have learned from within our membership community to prove to others that impact investing is viable and possible, and that you can take those steps to do that with yourself and with your own portfolio. So we have a couple initiatives on that side too.
Thanks, Kim. Andrew, at UBS, you're the Global Head of Sustainable and Impact Investing. Can you give us a sense of your responsibilities and how you interact with the rest of the bank?
Sure. So look, I think our objective is really to help all of our private clients around the globe invest and meet their objectives overall, whether those are financial objectives or whether those are beyond financial objectives. And I think what we've very clearly seen in the last number of years is that sustainability has come to the fore in terms of what investors are interested in more broadly. And so the question about sustainable investing is, how do investors incorporate sustainability and impact into their investment portfolios in ways that make sense for their financial objectives and also for their sustainability or impact objectives, whatever they may be. It's not very binary, right? So, the sustainability teams for global wealth management at UBS are here to help our private clients with everything from how do you think about bringing sustainability into a portfolio, and what does it actually mean? What are your expectations around that? So thinking about everything from discovery, what are clients interested in? How are you thinking about objectives? What are the themes that matter to you? And how does that fold into investment portfolios? So think about everything from asset allocation to thematic development to sector views and single securities, thinking about how all of those fit into an approach that's either about removing certain securities from a portfolio or exposures from a portfolio, to thinking about how sustainability affects their investments from a risk and opportunity perspective. And for those clients that are leaning into sustainability and thinking about how their investments impact broader society and the environment, what are the types of solutions that enable them to do that? And bringing forth a whole offering that says, from advice to actual solutions that help do that, how do we help advise you to do that? And we certainly see that that's been a trend over the last number of years of great interest as clients are transitioning their portfolios to focus more on sustainability and impact.
And I want to talk about that trend because you're right. It's definitely becoming a huge deal and it's only becoming more and more popular. But it seems like terms like ESG, sustainable finance, and impact investing are used interchangeably, but they really aren't the same. So could you guys kind of run through what the differences are and how people should be using these words and terms?
Yeah, so I think ESG gets thrown around a lot, and I think, so I'll just start there. So ESG stands for environmental, social, and governance, and this is essentially a way of looking at companies and how they relate to those issues. I think what a lot of people don't understand about ESG is that ESG is really focused on looking about those environmental, social, and governance factors that are going to have a material financial effect on the company. So it's really still rooted in looking at the financial impacts of the company, which may or may not meet the expectations of investors who want to solve the climate crisis and have more flexibility on financial risk and financial return expectations. So ESG is a little bit more narrow than I think it gets used. I often have to ask people to clarify what they mean when they say ESG, because I think they think it means something quite broad, and it actually is a little bit more narrow. At Tonic, we like to distinguish between values aligned investing, which is investing in something that is, that you feel good about, that you're proud of. You can look at your investment portfolio and say, I'm proud of this. But there's another layer that's really important when we really are looking at impact investing, which is additionality or like contribution. So if your investment dollars are doing something different that wouldn't have otherwise happened, that's really kind of a higher bar to meet. But it's important to kind of understand that as a more strict understanding of impact investing, as instead of conflating them, which I think is not helpful in the long run.
Yeah, I think that's a great way to frame it. I think the terminology is something that has tripped up many people because it sounds different. People refer to it as ESG, values-based investing, sustainable, SRI, sustainable and impact. And I think, stripping it back to what are you trying to achieve as an investor, regardless of what a fund or a product or what have you is labeled, and how does a particular investment solution actually match up against those intentions? That's the key thing. So there are products that should exclude, right, and are more about values alignment, don't necessarily contemplate the investment return piece of it. There's the piece of it that is about ESG integration and bringing sustainability factors where they're material, just like you said, into an investment process to enhance the investment side of things, but not necessarily lean into sustainability or impact. And then there are those, themed types of products where people are leaning into sustainability, where you want to see a sustainability objective. And that distinction we very much agree with you on. The idea of impact investing being driving measurable positive change. And that is different. That is distinct from, portfolio, let's say, of liquid securities, where you're just aligning to a set of companies that's operating better, but no incremental change is actually happening. So I think, getting away from all the terminology and saying, what does this investment solution actually deliver to me? That's the key thing. So it's not easy to cut through all the terminology, but trying to do that, I think that's what advisors like, Tonic or UBS are here to do.
That makes a lot of sense. For people who are interested in impact investing, is there a trade-off in terms of financial returns for those investors?
The short answer is no, but I think you can get into a lot of nuance there. I think that depending on the problem you're trying to solve, there may not be a way to responsibly get a market rate return, because the market rate is really capturing a lot of externalities that might be running counter to your goals. And so I just think there's a lot of layers to unpack there, but we're lucky that we're at a time where the impact investing in the ESG market has matured and grown enough that you can build an entirely diverse portfolio that is aligned to impact in some way. And depending on how specific your goals are, that might be easier than in other situations. So I think another important thing we've seen at Tonic is that people are meeting their return expectations, but it's helpful to look more broadly at your entire portfolio and get creative. So when you're looking at a foundation's assets, for example, they're already giving money away, which is a negative 100% financial return, right? And so when you average that into the portfolio and you look at the impact and the financial returns more comprehensively, you can get into a lot more creative solutions, and a lot more solutions will be available to you in terms of maybe taking less return over here because you've got more return here, but overall you're meeting your goals. So.
Yeah, I think the universe of sustainable investing solutions has grown massively over the past decade. And we would definitely say you can build sustainable portfolios that deliver comparable market returns, and in certain cases have actually delivered outperformance. We wouldn't underwrite to the outperformance, we underwrite to comparable performance because we think across asset classes there are solutions that do deliver that. But certainly I think there's no give up when we think about it. I think at that far end of the spectrum where you think about tangible positive impact above and beyond a baseline, that's when you start to think about there are opportunities, right? Certainly in the areas of climate, health, education, and elsewhere, where the opportunity sets are so large that there are commercial solutions that can really deliver at or above market rate returns while having that tangible positive impact. But it's not everything. So I think this is what you were getting at before, where there are some areas where you might have to take longer time risk, right? Or perhaps the risk that the financial return won't quite be there in order to really solve problems in certain geographies, right? So education in certain emerging markets, right, might require you to take longer duration or might require you to take a lower risk, lower return in order to really catalyze the type of impact that we're talking about in terms of positive returns. So I think when we talk about investment portfolios, what we're looking for are those opportunities that really do deliver on the financial return side of things, as well as on the tangible impact side. But there needs to be a recognition that it's not all of the challenges that are out there from a sustainability perspective that can be solved by market rate returns. But when we think about investment portfolios, those are the types of things that we're looking at.
Yeah, and just to add to that, I think that's a great example that, education in a hard to reach geography, they're not served by the market. So the market rate is probably not the right benchmark for that type of activity, that type of positive impact you're trying to create. And so we like to use the term appropriate returns, which is very situational and important to apply when you're in a situation like that, where market rate return may not be the available choice or a responsible choice as an investor trying to do good.
So what advice would you give to investors who are looking to invest in an area that will make an impact, but also grow their portfolio?
I can start. I think it's again, going back to, as an investor, thinking about what those outcome areas or themes are that are of interest to you, and whether you invest in those or support those with capital through a philanthropic pocket or whether it's through an investment portfolio. I think that's the first thing, is to identify what you're interested in it. And then I think it's about identifying, what's the type of change that you want to see, and what are the best instruments or tools within either your philanthropic or your social finance or your pure market rate type of investment bucket that you can use to address those, and what are your expectations around the type of change that you want to see, and then looking for the right mechanisms, whether that's public markets and using engagement type strategies to really drive change at public companies, or whether it's in the private markets and looking at growth capital or venture type investments that might support disruptive technologies in any of the areas that we talked about. So I think there are a lot of opportunities for sustainable investors or people looking to drive impact, and it's about being specific about that. But diversification is good across whole investment portfolios, so it's important to think about making sure there's diversification so you're not overly concentrated or exposed to specific risk in anything, like climate specifically, for example. You can't necessarily orient your entire portfolio towards solutions to climate, but you can think about different ways to address it across a portfolio.
Yeah, and I think to add to that, in addition to those steps, if you're looking at one particular company or particular fund, and clear that you need to meet market rate or better returns as well as certain impact objectives, look for where those are working together in concert, right? So like every additional unit sold is actually working towards meeting your impact goals, and where those are really working in alignment, you're going to find the best sort of like win-win solutions there.
I think one comment I might add to that is, when we think about investment solutions that are delivering positive impact, as an investor, if that's your objective, to get the returns, but also to achieve certain things, I think what you want to look for in that investment solution is the intentionality and how much that is baked into the approach that the investment manager takes, right? We've seen an explosion in sustainable investing solutions, which range across the different types that we've all talked about today. But not all of those are actually delivering in terms of the investment manager incorporating that into a process. It might just be something where it's labeled a certain way, or where the impact is actually a byproduct of the investment process itself. What you want to see is investment managers who say, this is an interesting opportunity. This is going to contribute to the returns that I'm delivering overall, because it's either a huge market space, or I think I can add value, and bring more impact along with performance. And that's what you want to see. And I think we do see that across the asset management industry industry is a real commitment to say, these are interesting and relevant and material factors, both from a risk perspective and an opportunity perspective. And we're changing the way we manage things, not just relabeling strategies in order to actually achieve that. So that's what I think people want to look for, is intentionality in the strategy.
I love that. I want to open it up to the audience. If you have a question, please raise your hand and we will maybe bring you a mic. If anyone have any questions?
How do you rate companies on the ESG scale? You know, is Microsoft?
Oh, we got a mic.
I was going to ask, how do you rate companies on a ESG scale? You know, big tech, is Facebook ESG, is Microsoft part of ESG portfolios? What is included, what is excluded, and how do you judge?
Yeah, so I think the way you phrase the question is really interesting. It assumes that it's either like yes or no to ESG, which isn't true. I mean, there's so much nuance and there's a wide range of scale there. I think there's also like a recent study that showed that 90% of stocks on the stock market were actually included in one or more ESG funds, or funds that were labeled with ESG. So, you know, I think there's some real opportunity for growth and better like precision around what we really mean when we're looking for that. So I'm not an ESG rater, so I'll say, you know, I'm not involved in that. That's not something that Tonic takes on. We try to find the best resources for our members, but that's not something that we take on. But it's a much more nuanced question than that. And I think what's challenging is that your question also sort of implies like, is this a good company or is it a bad company? Well, what you think is a good company might be very different than what I think is a good company, and everyone, and so on and so on. So it gets a lot more nuanced. And there's also a lot of data that's not yet available to the public or to even some of these ratings agencies. So companies are not even required to disclose their equal employment forms that they're required to keep when they're hiring, but they're not disclosing them. So we can't even really get a good look at, you know, are they promoting women and people of color at equal rates? Are they hiring women and people of color at equal rates? We don't know that yet. And so there's a lot of progress to be made on that front.
I think Kim makes a great point about it's not binary, right? You really can't look at it's either is sustainable or it's not sustainable. I think the way that we look at ESG data is that these are all inputs into an investor's decision process, and how you factor in what's material or relevant to the investment analysis at hand is really what's important. As a long-term investor, you're going to think about that in the context of all the other fundamentals and make a decision on a relative basis. So I think that's the way we think about it, and less about a single rating for a company driving the sustainability or lack of sustainability. I think the other point to make is when we think about sustainability of individual companies, for example, you can think about it in two regards. One of which is the operational performance of a company on environmental, social, or governance metrics. The other piece of it is the products and services that they actually deliver. And those may not entirely go hand in hand. And so thinking about which piece of it is important to you as an investor, and again, what type of exposure you're looking for. So you might be looking for, in the equity space, for example, companies that are leaders and from an operational performance perspective, but not necessarily thinking about the thematic or product alignment to sustainability themes, whereas someone else might be thinking about thematic is a really interesting thing, and I'd like to get exposure to electric vehicles and wind turbines, but that's a very different type of exposure. So again, thinking about what you're trying to achieve across a portfolio, diversification is a good thing because you might have different drivers behind that, but that's really the way we think about it.
Sharon.
Thank you. Oh, if we take, say, let's just say this whole ESG, it just seems to be coming on so much faster than I expected. Maybe not that you experts expected. But what would you say in the past 12 to 18 months has surprised you in this space? I know it's a very broad question, but.
Yeah, I think one thing I've noticed that I didn't expect is there's an increased interest in different ownership models, which I think is really fun to think about. People who are interested in employee ownership and co-op models. And this is sort of a new interest that I've seen crop up in the last year that I didn't expect. And I think it's really awesome to think foundationally at, as we think about our economy more broadly and the companies that make that up, what do we want those to look like?
Yeah, I think the surprise is actually the rapidity of adoption, right, that we've seen amongst investors, both institutional and individual. And I think while both Kim and I would probably say this is what we were expecting because these are relevant factors to consider and the opportunity sets are huge and people are more interested in driving change and making a difference and having their capital invested or allocated in a way that makes sense to them and comports with sustainability objectives. I think, you know, during the crisis, at the beginning of COVID, we had market dislocation, and there was a question about would people say, you know what, sustainability actually is going to take a backseat. I need to make sure that I have my financial performance. Actually, instead, what we saw was a continued inflow and almost an acceleration, perhaps to the upside of many people. So I think that that continued adoption and the rate at which it's being adopted is surprising to people. And then you think about consumer shift in terms of preference on sustainability and the regulators, and I think it just compounds things. But I think maybe the rate of change is what surprised us.
Thank you so much. And we are actually out of time. So I'd like to thank Kim and Andrew for a wonderful conversation. Everyone else.
Thanks for having us.
Thank you.